Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. Michael Oliver, founder of Momentum Structural Analysis, is a leading expert in financial market trends. Known for his momentum-based analysis, he identifies key market shifts across commodities and equities. With decades of experience, we'll be picking his brain and asking the questions that you submitted. Michael, thank you for coming back on the show.
Good to be back, Steve.
Yes, sir. The pleasure is all on this side of the table. Let's go ahead and start like we always do. And what is your macro view of the world economy and financial markets today?
Oh, golly. We don't want to talk about that. No, stock market, I think, has peaked. When I say peak, I don't mean for a correction. Too many, I've said this before, it is the biggest and oldest, most bloated bull market in U.S. history, meaning it is the biggest stock market bubble in U.S. history. When it breaks, and I think it has begun to break, using the excuse of tariffs, I don't think that's the causal factor. It just, any excuse would have worked. I think it's underway, and I suspect for the next couple of years, it's going down very hard, and there'll be real world consequences. This time, it's sort of unique, though, and some other analysts are now noticing this. We noticed it a month or two ago, that T-bonds normally respond in a positive way, meaning upside in price, lower in yields, when the stock market gets in trouble. Because asset managers and investors move over to, quote, what they consider to be a, quote, safer alternative. And it usually works. Go back and look at 2000 to 2002, 2007 to 2009. Stocks went down, bonds went up. Along with gold, by the way. Gold was the other alternative. This time, only gold seems to be the alternative because T-bonds are waddling in mud for 2.5 years now, sideways in price after a huge collapse in 2021, 2022. They can't seem to get off the ground. And we did some analysis on T-bond futures. We're using 30-year futures now, 30-year bonds. And we saw a technical case for them to participate on the upside with gold back a couple of months ago, and they crossed a few numbers that we wanted to see crossed and some momentum trend structures that were of intermediate quality. And we thought, okay, T-bonds then were in the upper teens, 115, 120 zone. We thought they could get up in the upper 120s. And that would be, last several months or a quarter or so while the stock market weakened. They tried to. They got up to 122 last month, early in the month. And within 2.5 trading days collapsed to 111. Now, 11 full point drop in bonds in literally 2.5 trading days is highly abnormal. For bonds, that qualifies as a crash, U.S. government bonds. Since then, they've waddled mostly in the lower half of that range. They've gotten up to 117, 118. Right now, they're trading 114, 15 area. So we've scratched them off our list. We admit that our intermediate positive call, which we thought could get in the upper 120s, instead has stopped at the lower 120s, failed. And therefore, we go to neutral on bonds in terms of their potential to rally or sell off. We're not quite sure which. I tend to think the rally potential is gone now. And there's a big risk. This is, you ask about world situation. God forbid T-bonds start down hard, especially in an environment where stocks are going down, because that puts panic. There is no alternative in the norms, the normal alternatives, in which case gold or monetary metals are the isolated place to be. If they get down, T-bonds right now again at 114, 115 zone on the nearby future, June. You get down in the mid 111s again, get back close to that low we made in early April. By the way, it crashed at basically the same time the stock market went down. You get back down there again, you don't want to. Because at that point, it argues to us this whole basing effort by T-bonds for the last 2.5 years of sideways boredom is ending in a negative way, not in a positive way. And that will really upset the world.
Okay, so I'm going to share my screen here if we can visually see what it is that you're talking about. So here's the S&P 500. And you think that we've already peaked here? You feel
Yeah,
like,
I think that was the top. In fact, in January of this year, that's a couple weeks before you made the high. There's a drop there prior to the high, right in that zone there. Yeah, right in there.
yeah,
We went major negative. Okay. We said quarterly momentum of the S&P, meaning when we measure the S&P, whether it's above or below its three-quarter moving average, we oscillate it. We create a different looking chart than what you're looking at there. We had a floor come out then at that point. Well, a couple weeks later, it actually went up and teased a new high,
yeah,
which did not negate our sell signal. It did not. It rally in the context of something negative in our view. And sure enough, that new high didn't work, okay, for the price guys. They thought, oh boy, another breakout. And look what happened over the next 5, 6 weeks, okay?
yeah. Massive
Boom.
sell off.
Now, that low down there near 4,800, we predicted prior to that collapse that the low for the S&P would be around 4,800. Okay. And for the NASDAQ 100, we predicted before the collapse that its low would be around NASDAQ 100 now, 16,500. It stopped at 16,530, I think. What is that? Well, actually, if you go back further on this chart, you'll see that on a monthly, look at the 2022 high on the S&P.
2022 high right there.
Yeah, you drop down to the old high. And same with the NASDAQ. Its old high was in late 2021. So in literally 1 month there, you wiped out a whole year of upside,
Yeah,
and price was back to a level where if you were long in 2022, you were break even.
yeah,
Okay. Well, anyway, it did bounce from there. We expected that. Not so much because it's a price level that an idiot could draw, with a crayon, but that there was some momentum reasons to think short term you could get a bounce. You were oversold and so forth, and we got our bounce. Nice and strong. In fact, most of that bounce, about 90% of it occurred. If you go back to a daily chart of that now, look at what happened. That big green bar, 2 days off the low. 2
right
days
there.
off that
Yeah.
low. That
You get rid of
huge.
the
That was
volume.
when Trump. And pardon us for saying this. We're not anti-Trump. We're not pro. We're not involved in political politics here. But it's like investors were acting like a herd of sheep.
Hmm.
When the shepherd came out and realized the sheep were nervous, he said, "Oh, I'll give a 90-day pause." And that's what that day was, 90-day pause. So we exploded a huge up day.
Yeah,
Like all the sheep said, "Oh boy, we're back in line again. Thank you." Okay.
yeah,
And then it started to weaken again. And then they came out, well, I forgot what the other statement was, but a week or two later, they saw the market drop. And again, there's some kind of soft statement came out, and the sheep got back in line again. Okay. Now you took out the high of that little basing action there, where that high of that day was like 5,400 and something, that big green day. Yeah, right there.
Yeah.
Or there's your horizontal. Look to your left there. You'll see there was a low prior to that collapse that occurred right about that same level,
yeah.
back in March. So that's a price level now that the price guys are going to be watching.
Right around here.
Yeah, right around that level, around 5,500 plus.
Okay.
You really don't want to, if you're a price guy, and frankly, momentum kind of agrees with this, you don't want to get back below that level again, because that would indicate that the quote breakout you saw about 6, 7, 8 days ago, which hasn't produced much, by the way, you can see it.
Yeah.
Yeah, no big deal. You get back below that, it's saying, hey, that breakout is being aborted. We're back below the breakout point. Uh-oh, what's going on? So that's a level I would watch right now if I were a near-term trader. But as far as the long-term trend, we're negative.
Okay.
We do not trust the rally, period.
Yeah. Yeah. Okay. I'm kind of in the same boat. I feel like that was the high. We may not see this for years again,
I don't know.
1,600.
It's hard to say.
Yeah,
I mean,
who knows? But
when you made a top in 2000, it took till 2016 before the NASDAQ 100, which was the leader index back at the dot-com top, for it to get back to that price level again. 16 years. S&P took 13 years to get back there. Anyway, yeah, go ahead.
okay. Let's see. So biggest one in history is underway. We're watching it unfold in real time. And then you mentioned bonds. I'm just going to bring up the 10-year here. This is the yield. So we
Okay.
saw the drop in yield, which made sense because when
Hmm.
the stock market is uncertain, then people run into bonds, and you should see the yield drop like this because that means
Hmm.
people are
Hmm.
piling in. But then it just spiked way up here, and
Yeah.
it went down here from 3.8 all the way up to
Yeah, that
4.6
was the
about.
bond price crash was right then. Yeah, and look at when that occurred. That was in again the early in April when the S&P hit its puke. Okay,
Yeah,
uh, but if you go out wider on this, go back another couple years to 2022, you'll see look at that sideways action around that 4.28% you got marked. I mean, on the right it's highlighted 4.3, let's say. It's been
yeah,
sideways since July of 2022.
yeah,
So what it
yeah,
says is these high yields have been choking and not letting up for 2.5 years now,
yeah,
almost 3 years. Okay. So while the Fed may have cut rates during that time and then raised rates a bit, it doesn't affect this long-term end, the 10 or the 30 year. But yields are just at a choking level and they're not relenting. And this could be, you could say on the yield chart, it might be a topping action. Well, that attempt to break down in yields that you saw that spike down there,
yeah,
it quickly said, nope, not going to do it.
yeah,
Okay? So, what's wrong here? You've got good validation to do it. You've got an asset category that's supposed to be safe. Stock market is now questionable. Not to most people, to us, it's not questionable, but they're not flooding their money into this market. This is of real concern to the central government and the central banks, not just our central bank. Government debt, because that's a crisis on the side. We all know about it. Everybody's been talking about the government debt to, GDP. But sooner or later, that's a fact that will pay dues unless something magical happens. Okay. And it doesn't appear to be happening, and even with the excuse of a wobbly stock market. So, God forbid this guy turns up out of this yield pattern instead of down,
yeah,
which you just tried to do but didn't succeed. So right now you're sideways for 3 years,
yeah.
choking, like commercial real estate debts and things of that sort are coming due now this year and next year, I understand. And so that's why we focus also on like other sectors other than tech, like commercial real estate.
Okay, I'm gonna. What's it? Boy Wonder is asking a question about S&P is hitting critical resistance, which we kind of talked about, at about an
Yeah,
all-time high.
we predicted certain resistance levels on this bounce. We got to them last Friday. Since then, we've wobbled off a bit. Question is, will that resistance persist? Perhaps, in which case, then you go back the other way, to the downside.
Yeah,
But it is a momentum-based level of resistance. And not so evident on price, but on momentum, where we bounced up to is like the bottom side of the floor we broke. Okay.
yeah,
So,
yeah.
okay, get the point. Yeah.
Okay, he's also asking about a Fed pause. So we're recording this at about an hour before the Fed has their
Yeah.
meeting, and
Yeah.
traders right now have them at a 97.7% chance that
No
they're going to
change. Yeah.
pause. So
Yeah. Yeah.
I think we'll just assume that they're going to pause and that most traders are right. He's asking, will a Fed pause cause a market sell-off and affect mining stocks kind of by the dip moment?
I don't think so. I think the Fed is pardon me, they cause certain things like boom bust cycles because of monetary boom bust cycles. Hence, that money, when they create it, goes somewhere. And often it will go into the stock market. And you can see, you go back in history of an M2 chart, or especially a Fed funds rate chart, go back 50, 60 years and look at it. And then look at when it made its lows and its highs, and then look at what the stock market did subsequent to that. If they started lowering rates again arbitrarily, this is not market price rates, but look where we are now. Go back to look, you go back to the 50s. Okay, versus all the rates of the prior 20, 30 years, we're very low still.
Yeah,
We were free for 10 of the past 15 years, basically.
right here.
And,
Yeah.
that fuels what? Well, it fueled the biggest stock market bubble in US history. Okay. rates, especially look where it started, 2009 low. Well, that's when the S&P bottomed.
Yeah.
And they kept, when they took rates up a bit and then COVID hit, they took them back down to zero again. And then they took them up, but everybody says, oh, they took them up, but look where they took them up to. Trivial level compared to historic levels. So it's still pretty low levels. What that means is free money.
Mm-hmm.
Okay. Cheech and Chong world, free money. Have a good time with it, get hallucinated, buy stocks, etc. So no wonder we have a 15-year-old bull market in stocks, like 3 times older than any prior one. And it's triple to quadruple the size of the biggest bubble before in terms of multiple gains. It's a 19-fold gain in the NASDAQ 100 from 2009 to 2025. There's no comparison in history. .com doesn't compare. Nothing compares. So, and you look at this and say, oh, now I know why. It was drug infused. Okay.
Yeah.
And money supply growth also. But anyway, so what the Fed tinkers around with here right now doesn't really matter, because if you're hoping for rate cuts to help, quote, help the market, you don't want that. Because if you go back archivally and look at 2000, 2002, or 2007 to 9, the Fed started cutting rates early in those bear trends. And they cut rates all throughout the bear trend. Did it help? No. The bear trend was reality. It took over and said, we don't care what you do, Fed. We're going down. We're going to puke up the excess. And the Fed tried to stop it. It couldn't stop it. Finally, they came in with QEs. Bernanke did in November of 2008. And that still didn't help. It helped gold massively.
Yeah.
Gold immediately returned to its highs. And the S&P went down for 5 more months, even with the QEs. I wouldn't be shocked they start QEs again at some point. Heck with the rate cuts alone. And even the head of the Boston Fed, the woman who's, I don't know her name right now, but like a month ago, she had a press conference or a speech. And she said, if there's any kind of crisis, we have multiple tools. She didn't say just rate cuts.
Yeah.
Okay, well, we know what the multiple tools are. And the fact that she even mentioned that had to be something that would be permitted from above, if you know what I mean.
Yeah. Yeah.
The Fed doesn't say things like that unless they intended it to get out there,
Yeah.
to let people know that, no, we're not going to cut rates, but we'll do it if we have to. And we got other things too. And don't be surprised. But no, cutting rates will not impact the stock market positively, maybe for 2 days.
Okay.
But in terms of sustained, no, it won't work.
Okay. All righty. Let's move on to our favorite yellow metal here. Philip is curious. He says, how deep will this correction be in gold? Do you think it can get to 2,800?
No, I don't. I think we're in it's not true with silver yet. It's true with gold. I think that the upturn we had that we called back in March of 2024, gold was coming up to 2,000, just above it again. It had been there before.
Okay.
Yeah, there you go. You see that 2,000 level. You've been up there a couple times. Well, too many times. And this time you went through. Okay. And you surged. But notice the angle. There was surge and then a multi-month pause, another surge and multi-month pause. But you didn't pull back at each of those pauses to the top of the prior high.
Oh,
So
yeah. Okay.
yeah,
So you're saying from here to there, that didn't.
Well, you didn't drop back down there to 24, nor did the
Yeah.
2,400 high drop back down to 2,000. It didn't do that. Yet each time we had a pullback, that seemed to be the chorus.
Yeah.
You're going to go back to the last high and find support. Well, that for us, it's 20. Well, it's actually 3,200, and we didn't even get there.
Yeah.
Stopped at 3,230, I think, and now we're 30 either side of 3,400 in 48 hours. Okay.
Yeah. Yeah.
Notice the pullback was very quick.
Yeah.
Measured in days, not weeks or months.
Yeah.
That, I think, is the new nature of gold.
Okay.
Yeah, you'll have sharp, probably single percent pullbacks, 5, 6, 7, 8, 9%. And then bam, look what happened.
Yeah. Yeah.
What's gold drugged or something? Yeah, it is. It's drugged on monetary excess, and it's the chief benefactor. So now silver's not in this condition yet. Gold is now moved into a more accelerated angle of ascent. There goes silver now. This is when I sent you a couple of charts, Steve.
Oh, yeah. Let me.
We look at this chart here first. This goes back to a year, to May of last year. This is daily.
Yep.
You got up to like almost 33 in that move in May, a year ago. That's
A year
yeah.
ago in
No, no,
May.
no,
Yeah,
you're
we
right
got
there.
up
Yeah.
to
Just short of
32.70
33.
something. Yeah,
Yeah.
about 33.
So on a point and figure, you got up to $32 on X and O chart, and then you pull back. Okay. Then you surged up and got to 35, back
Yep.
that would be in October, okay, last year. Then you had another drop, and then you had another move up to 35. You did not get to 36, so you stopped at the same $1 tick,
Yeah.
like on a point and figure chart. And then you had this puke where they said, oh, silver's going to go down with the stock market. Okay, well, actually, what that drop is about 2 days.
Yeah. Yeah.
Okay.
That's one
Okay.
bar, two
Yeah,
bar, and then recover.
and we've erased one of the bars and half of the other already. So if you got short, if you didn't short it right at the top, at
Yeah.
35, and you shorted in that panic, you're a loser already. Okay.
Yep.
And it's not falling back down. It's
Yeah.
clustered. Okay. Now, if you go to my charts, I'll show you why it's clustered there.
Okay. And wrong one. There we go.
No, yeah, there we go. Roll up to the top chart. Can you see both the top and the bottom? Okay, let's look at the top chart first.
Okay.
That's the price chart, but this is weekly instead of the daily we were looking at. And you can see that there's a range since a year ago in May. We were at 32.70, and right now we're 32.80, I think, today as we're talking. Okay, so 1 year of sideways, okay, with violent up and downs above and below that level. You got up to 35 twice. You got down under to 28. You got down to 27 and a half, So violent moves either side of the center of that box, but basically you're in the upper quadrant of that box now.
Yeah.
But if you look back at the price action that occurred back in 2022, see the green arrow there on the left on price? Yeah. If you'll recall, that was when gold had its flush, where it had been in a range from 2,000 to just under 1,700.
Okay.
Back and forth and back and forth. In August and September of 2022, the same time, this shows late August of 2022 on silver, you had a puke. Gold went down into the low 1600s, and it blew out a floor that every price guy could see. And so it was the end of the world. We're going to 1200, et cetera, et cetera. We called it a bear trap. In other words, we said, no, this is not real. It's a fake out breakout in price, because momentum said no. Okay. And sure enough, boom, you shot back up quickly to 24 again. And even that's the first surge there out of that hole. Yeah. But now look what happened. You peaked there at that first high, which was like $24 on a $1 chart, that is. Mm-hmm. Okay. And then you pull back down to 20. Then you went up to 26. Yeah. And remember, this is sort of like what you see on the right there from May of last year to the present.
Same kind of pattern, just a different.
Yeah, it's the same thing. You make a high that's not the top of the range, then you pull back, then you go up and define the top of the range. In this case, it was 26. Yeah. Pull back down again into September of 23, and then you came back up in late 23 to 26 for a second time. No, over to your left a bit there. That's second. Right, yeah, that one. So that's your second rally to 26. So guys sold it there saying, I'll risk a nickel and sell it at 26 and get rich. Okay. Well, they got a $4 drop down to 22. Mm-hmm. And then it came back up and threatened to touch 26 again. Yeah. Didn't quite touch it right there. Pull back a bit. They sold it right in front of there. And then when you went through it, it was what you call a triple top breakout. Yeah. When you touch 27. But actually, the history of silver, and this is true with gold, you never make a major top with double tops. If you go back and look at the major tops in gold or silver, they're isolated peaks. And then you drop, and then maybe you make multiple highs that are below that. But you don't keep coming back up to the top tick. Yeah. That's a statement of intent, even if they sell it there repeatedly. Well, we have the same type of behavior now. It's a year wide, 2 peaks at 35. We just had a flush out that no doubt cleaned out many price chart guys. Yeah. Put their sell stop down there about 29 when it blew out that low in December. And then boom, right back up again. Okay. Yeah. Now I'll go down to momentum below. Momentum. Now, okay. Now this is back in that 2022, 2023 period when price was making a double top. Momentum was correcting. Momentum went into a descending pattern. And in fact, if you go back to the high in late 2022, which only stopped short of 20% over. Yeah, that one, there's a wave down, and then you go up and make a high. Then there's another big wave down.
Mm-hmm.
Yeah, all the way there to the back down to 10% under. Okay.
Yeah.
Then you go up again to 10% over, which happened to be a prior high. Then you come down again, a third wave. And it's when you set up a multi-wave, aged, downtrending pattern on momentum, it usually has intent to go through it, meaning you're defining a structure for purposes of starting gate for a new trend the other way. So while price went sideways, momentum cooled off. It corrected. You can notice it went either side of the zero line. So the 40-week average we're using here as our metric is like a 200-day average, about
Okay.
give number of days, or 3/4 average, are about the same duration. So the zero line, the average itself didn't mean anything. And you wove above and below it, but you set up a structure. And you came through that structure there in March and April of 2024, when we said at that time in our reports, the metals are about to go berserk again. Well, if you look back at the price chart there, that's where that circle is on momentum. That's when price at the top chart went back up to 26 again.
Oh, yeah,
And you're hitting the triple top. And so while price was at the triple top and breaking through, momentum was breaking through also.
Huh.
So momentum was saying, this is valid price breakout stuff. You can trust this price breakout because momentum is breaking a pattern of congestion pullback that has existed for over a year.
Yeah.
Okay? And you exploded from $26 up to 33 almost in the first surge, and ultimately to 35.
Yeah, right up
So
there.
you had a pretty good surge. That's a big move, 26 to 35.
Yeah.
Big percent in a matter of months, but now that's the same pattern. Price has gone sideways with the double top set, meaning a potential triple top breakout. And momentum has an even clearer three-wave downtrend structure.
Yeah.
And I keep saying three-wave because in momentum, if you can define three clear waves of momentum, whether up or down, beware, that's usually the end of the momentum trend. In this case, we're dealing with a long-term metric. So when this guy changes, it's not just for 2 weeks. It could be for a couple quarters or a year.
Yeah.
The breakout level is at about 10% over on that oscillator. You can see if we get up there, and this chart is not much different this week. This is as of last week. It's a little bit higher on momentum. Price is up a little bit too, up about 60 cents, I think, right now. Yeah, it was 32.26. We're 32.80, so we're up 60 cents from that chart there. But you get up above, you could approach $35 again. You don't even have to touch it. Momentum will be at that line.
Oh, okay.
So in other words, while price goes back to what could be a triple top breakout, momentum says, yep, watch out. I've got a multi-point parallel channel. In fact, you could draw a channel under it. And I'm blowing out of it. And that's a year-wide correction that didn't yield a price decline that sustained. It yielded a sideways price action, which is a positive statement in itself. Sell me all you want, but I ain't going down. Okay.
Yeah. Yeah.
And this momentum chart and the price chart both now say, I am now set to launch again.
So this is the price action right here when people are looking at a price chart.
If you go back to 35.
This is kind of like a coiled spring here, right? And you're basically saying that once the momentum breaks a sustained break above this red line, that's when it's also.
Yeah, it says somewhere just below 35, you close a week out, that line's coming out, okay?
Yeah.
And in which case, the price, don't expect 35 to stop you a third time, okay?
Yeah.
It's going to be a launch pad instead of a quote top. Right now it's a technical double top. That term shouldn't really apply. And if you go back a third time, it's a pending triple top breakout, just like it was back in March of 2024. Okay. So there's very similar behavior here, just at a much higher price level than we were then. And momentum is hyper clear. And now the point being, we looked at the gold acceleration, but price, it was behaving in an accelerated manner. Silver clearly isn't. Okay. You get through this red line on momentum. Our bet is, and my own personal investments reflect this, silver will outpace gold hands down.
Ah.
Yeah.
Okay.
And one thing I like about that statement is that Goldman Sachs, which is a firm that's positive on gold, has basically said silver is not going to ever catch up to gold now. Silver is just, it's too industrial. It's industrial demand while the solar panel demand is good. It's leveled off, et cetera. It's as if that's what drives only these monetary metals. Chinese solar demand for solar cells, you know. Technically, I argue they're going to be wrong. Silver will outpace gold. It will go back up. And I suspect right now we're trading it less than 1% of the price of gold. Divide an ounce of silver into gold. Or the other way, the ratio, guys, 100 to 1. You know?
100 to 1, yeah. Yeah.
Yeah, in our way, just below 1%. I think it could go to 2% in a heartbeat.
Oh, that's
Now, you
encouraging.
say, whoa, big deal. Well, that's a doubling.
That's a
Okay.
double. Yeah, that is a big deal.
Meaning, if gold and silver continue up, and by the way, that spread never favors silver in the down market. It's always in a net up market for both. It simply means that during the uptrend, silver's outpacing gold. That spread is technically poised to break out. We don't see it here, but it's about coincidental with that momentum chart of the price action. So I'm arguing, I think we're on the cusp of where silver shocks people. It certainly put them to sleep, okay? And it's a good time to shock them when they're asleep.
Okay. That kind of goes into Susie's question. Silver passed the 35 upside move. Do you have any price targets once it does break that triple
60 to
top?
70 bucks.
Oh, wow. Okay, so you were
I don't think the
when you said
$50 high will be a barrier this time. We haven't even approached it. We got up, twice in 1980 and again in 2011, got to 50. But it was so brief, it was like thin air up there and it collapsed immediately.
Yeah,
Didn't
you could see it almost on an hourly chart. Yeah.
In fact, if you eliminate everything but high monthly closes, it's not even near 50, but the high trades were upper 50.
Yeah.
That I think is just a phantom price history thing. In fact, it's so old that it's irrelevant because if you do a real value of silver in real dollar terms, decaying dollar about decays 90%, it increases in supply about 90% every decade. So if silver were 50 bucks in 2011, well, we'd have to go to about probably 90 to 100 to be at the same real term price. Okay.
Yes.
But no, I think this breakout in silver could be the kind that gushes you past that silly 50 level. And of course, what's that going to do? It's going to smack in the face everybody who's looking at those old charts. Because they're not going to know where reality is going to be now. You're beyond all prior realities. In which case, then, real uncertainty sets in, a positive uncertainty. And I think you could surge past it in a big way, and such as to get up to 60 to 70 before you even pause.
Okay.
Okay.
Maybe my Pan American silver will finally start to really take off.
I own that one among about 5 or 6 others. So yeah.
Okay. Awesome. Okay, now the paradox, I guess, in relation to his name, is asking if gold and silver fall from here, at what point would you change your mind? So he's basically asking the inverse of that.
I looked at annual momentum of gold. Now, let me tell what's annual momentum. That's when we oscillate the monthly price bars of gold in their relationship to either a 36-month average or a 3-year moving average. Very long-term average, and not a 200-day, which is like 3/4, but a 3-year average. And so we plot, are you above it or are you below it? And it doesn't matter sometimes being below it. It's the trend structure we see on momentum, an uptrend or holding a floor, that kind of thing. We'd have to drop down like, off well below 2,800 to even begin to approach structure that's vulnerable. And you don't top gold that way. If you go back and look at the history of gold, and we've called the top in 2012, a few months off the high. Price hadn't really broken anything then. You're going to click it up there. Okay, it's 2011. Yeah. Hold on. That's 8, 9. Yeah, 11. Okay. You had a high up there in 1920, and you dropped hard down into below 1,600 within several months.
Mm-hmm.
In January of 2012, about halfway off that, no, 2000, yeah, right off that high, a couple of months off that high.
Right. You're talking from there to there, right?
Yeah, that's the bear market. That's 2011 to 15. But a few months off that down arrow back
Okay.
in there, a couple months to the right, we got major bearish. And we caught a lot of flack from subscribers who thought, oh, this is just a congestion zone prior to going, for higher,
Yeah.
And we said, no, I'm sorry, this time it's not. Because you can't see it here, but there was a 36-month or a 3-year average, I forget which we used, that had a structure that had been used as support, like a sliding board. It banged down to this rising structure. It wasn't the zero line itself. In other words, it wasn't down to the 36-month average itself, but to a rising support line on momentum, and you broke it.
Hmm.
A couple months off that high at 1920, you broke that structure. And that told me that even though price did not break that structure, momentum did, and it said, okay, it's over. Well, the gold wallowed around until early 2013.
Yeah.
In fact, no, right in that zone, that congestion zone you see near the top. No,
Mm-hmm.
we'll go higher, higher, higher. That
Okay.
secondary high was up to high 1700s there.
Yeah.
You never could get back to 1900.
Yeah.
It was never double top. Once you made the 1900 high, your secondary two highs were all below 1800.
Yeah.
So
Lower highs.
you could never get back to the high. So when you get back to the high again, like you see on the right there, back in 2020 through 2023,
Yeah.
this is gold now. You don't go back to the high again. If you go back to the high again, that ain't a top. That's a launch pad for future use. Okay.
Yeah.
Similarly, go back below, back in 2008, before that, you see multiple surges up there.
Yeah.
Up to around 1,000. You
Yeah.
don't go back there again. You should not have gone back there again if you're a bear. Stock market continued down to 2009, but gold went back to its highs immediately after that 1 month debacle in October of 2008. But when you go back to the high again, it's telling you, no, this isn't a top. Okay. Well, finally we collapsed. Now, you see that second arrow, you got the up arrow. That's December 2015. You look at the price chart, and you have to get up a couple $100 above there before you even break that little short downtrend line. Yeah, the surge there's a little downtrend there, goes back to 14. But there was an annual momentum flat ceiling that existed there, not this short-term downtrend that you see. But there was a flat ceiling between 2013, 14, and 15, where momentum kept coming up to the same level and getting repelled. And when it broke through at the price of 1,140 in February of 2016, we turned long-term bullish on annual momentum. Nothing on annual momentum has gone negative since. Despite that pullback in 2022, where we dropped down to 1,600, which looked like, oh, we broke through lows, right? Okay. We said, no, it's a bear trap.
Yeah.
And sure enough, it was. Boom, right back to the high. So nothing on this chart, you're not even near levels to break annual momentum. You could drop to 2,800. So first of all, we don't think you're going to. We think we're in accelerated phase now. In fact, if you'll draw a line through that 2016 high, go to 2000, that one right there, draw a line there and through the high of 2020.
Right there.
Yeah, just carry it on up a bit. Yeah, notice you paused at it right there.
Yeah.
Stop. That you paused at it as if I'm bumping the top of this parallel channel. Not a parallel channel, but an uptrend line of resistance. You tried to get through it and couldn't. And then finally, when you did, look what happened.
Yeah, just parabolic.
Okay. Even price at that point says, I'm in accelerated mode. Okay. I'm no longer going to go up at this staircasing manner. I'm going to go up in a little more vertical manner.
Yeah. Yeah.
Okay. Now, momentum also said that. Now, usually when these accelerations occur, it will sustain. You can go back in 1979, go back to 2010. You'll see that well before you got your peak, the acceleration occurred. And usually the acceleration phase would last for several quarters of upside, not just a month or two. Okay. Anyway, I think that's where we are. Now, silver conspicuously is still where it was a year ago. Yeah. Gold, of course, not. So gold has been beating silver for the last year. I think silver's about to catch up.
Okay.
Big time. Yeah. And
That's
in fact, if you look at that ink in 2011-12, you're looking at there, that clump, you see there is the bottom end of that is there in the upper 20s.
yeah,
And
26.
sure enough, we spent a couple of years trying to get through that stuff.
Yeah.
We pierced it occasionally. Yeah, pierced it a bit, but you really didn't close months out above it. Not until when? A year ago.
Yep.
Okay.
Yeah.
And we think you get up through the upper white line at 35, and I think that old high to the left will no longer be.
Okay. All
Okay.
right.
Yeah.
That is going to be fun.
And I think
Okay.
it could occur very rapidly once it starts.
All right. Platinum and palladium. Let's see. Philip wants to know, ask him about platinum and palladium. Who do you think is selling them? Is it Russia? Why are these metals so cheap?
We don't pay attention to those issues. Like we know that the Chinese have been buying gold, but that is hardly the reason that we're positive on gold. I know a lot of people think that's the key pivot of the whole thing. And if they pause, oh my God, it's all over. No. Gold's been around for 3,000 years as money. The fact that China acknowledges that is fine. Maybe they're late to the game and they're trying to catch up, and they clearly are. But that doesn't change the underlying reality of gold. And the problems exist well beyond who's buying it as to what's about to happen and is yet to really unfold. And that is the bursting of major paper asset bubbles and the economic downturn that will accompany it, because they always do. The data points follow the market, and the response of the central banks. And the central banks continually destroy the value of their underlying fiat currencies. Like I said, money supply here grows about 90% every decade in terms of how many dollars exist. And therefore, the stuff in your wallet is worth, about half what it was 10 years ago. So same with the stock. If you own a stock, it's now 20 and it was 10, you think you're making $10 over the last 10 years. No, you're not. You break even. Okay. Gold knows that. And so that's the bigger fundamental, and that's not a timing thing. You can't say, oh, this day that the Chinese did this or they quit. So who's buying or selling platinum? I don't know. Our assessment of platinum and palladium, we do it every month. We have a monthly commodity report where we include all the commodities. We do gold and silver constantly, but as far as all the other commodities, we do them monthly. And our assessment of platinum and palladium is, well, they're a bit different, actually. The platinum's been in a dull price range for many years now,
Yeah.
4 or 5 years, just sideways. Gold's gone up big, platinum hasn't. Platinum is behaving more like
right here.
Yeah. Now look at that. Now that's what, a daily or
this is
monthly?
A monthly.
Okay. Now
so for
try to
10
burn
years
that.
here, we've basically just kind of been in that.
Yeah.
range.
You had a run up there into 2022 where you got platinum up to 1,400. Now that's the same time that the Bloomberg had gone from a low under 60, like that red candle you see under 600 for platinum.
Yeah.
Yeah. That same period, the Bloomberg Commodity Index exploded.
Huh.
So Bloomberg was moving with the commodity index. Now, during that time, what was gold doing? Sideways.
Okay.
Gold had already hit its high by mid 2020. Bloomberg didn't make its low till like late summer 2020, when gold had already peaked for a while, gone sideways. Bloomberg exploded, gold went sideways. Platinum didn't go sideways with gold, it went up with the Bloomberg. Okay. Bloomberg peaked at the time of the war, February of 2022. That's, I think, probably when that platinum high is.
Yep.
It's what month?
February 21.
Okay. And then I think in 2022, it probably made a secondary high. But basically, if you look at the Bloomberg chart, it made a high in that surge and then spent the last couple of years below the high and sideways.
Okay.
Just like platinum. And show Bloomberg and you'll almost see the same chart.
AW1 exclamation point, AW1 exclamation point, and the
Bloomberg.
And there we go. Okay, we'll overlay the two of them. So here's the Bloomberg.
Yeah, there you
yellow.
go. You see what I'm saying?
Yeah.
It tends to ebb and flow. Now, it pulled back in when the Bloomberg pulled back.
Well, look at
that. Yeah. It doesn't correlate to gold very well at all. Platinum does not. It used to in the past. There were times when, oh, look, it made a high with gold. But even the high back in 2008 in platinum or so,
Uh-huh. Yeah, unfortunately, I'm
gold
at the
made a
point
high in
Bloomberg doesn't go back
2011. Look where platinum was, secondary high, 2011 when gold peaked. It
Okay,
was
right here,
new
yeah.
highs with gold. Gold's making all-time new highs, well above that 2008 high, which had been
Yeah.
$1,000. So Bloomberg commodity index and platinum correlate very well
Yeah.
in terms of major moves.
I'll
I
have to
think
get the
platinum.
Bloomberg going out further here. I don't know why it stops here at 2013. I must have the wrong symbol, but we get what you're saying. Like this
Yeah,
dropped, the
that's good
Bloomberg
enough.
dropped,
Yeah,
and then it shot up.
that's
And
because you've got futures. I think that Bloomberg.
oh, okay, I got the futures.
It doesn't matter, but Bloomberg peaked also back before gold did. It peaked like in 2008 and
Huh,
made a secondary high in 2011, just
okay,
like platinum did there. But anyway, so question about platinum is don't look at gold for platinum. There's no comparison.
okay,
Look at the Bloomberg.
okay.
So frankly, right now,
Here's the
they're
Bloomberg.
almost twins. They're almost twins. Yeah, they're
Yeah,
stuck in a 2-year plus wide range going nowhere.
yeah.
In fact, if you look at the bear low in 2020 and the bull high in 2022, the first wave of bull trend, I think,
Hmm.
there's 2 more to come, I think,
Yeah,
you've pulled
2020.
back 50%.
Yeah.
You've had a correction. In fact, you were there in 2023. You were at the same price levels you are now.
Yep.
You effectively made your 50% correction low 2 years ago and have gone nowhere since.
Hmm.
Commodity prices aren't going down. They're not going up.
Yeah.
Uh, And I think our momentum work suggests this is going to turn up.
Okay.
Already, some of our indicators have turned up for Bloomberg. And I think more evidence is needed, like another 4 or 5 points in Bloomberg there. It's 101.60 right
Hmm.
now. You get up above 106 again, watch out.
Okay.
Close a month up there, especially. The second major wave will commence. And of course, that will be a major upset to people who assume that inflation is going to be kept under control.
Yeah. 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 I took a small position in the Bloomberg last month or the month before.
Uh-huh.
But interesting. Okay. Um,
Oh, Palladium, the
oh,
other one.
Palladium. Yes.
Palladium's weaker than platinum, and it doesn't really behave so much like platinum. It does behave more or less on its own industrial demand needs, and it had a bubble. And when you create a bubble move, like Palladium did,
Hmm.
and you bust, sometimes it takes a long look at that.
Yeah. Bam.
That's a bubble top, and when you collapse, you collapse. Okay.
Yeah.
Now
Yeah.
it's saying now that okay, I'm back down to normal levels,
Yeah.
going back to decade.
Yeah.
So I can trust that it's basing here.
Okay.
Question is, well, for how long? And even if you turn up, I'm suspecting you're going to find resistance 1600 1800. Well, from 930, that's a decent move, but it's hardly anything like what you're going to see in the monetary metals.
Okay.
So
Okay.
I consider palladium to be somewhat of a yawn.
Okay.
And no doubt if we go into recession, I mean, its industrial demand will be impacted pretty good because, automobiles.
Yeah. The main demand for these two
Yeah,
metals is catalytic converters, and when
sure.
people have to decide between a new car and putting food on the table, they're taking food every single time.
Yeah.
Okay. All righty. Platinum and palladium, and let's see. Cabrita. What do you think of natural gas?
Natural gas has bottomed in our view. It is irregular in its behavior. It always tends to be, by the way, very violent percent-wise. I think it's bottomed. Its pullback recently does not negate that. We got bullish coming up through about 2.5, half a
Okay.
year ago, and it's since pulled back about to our buy level, but it's holding.
Okay.
And and it's irregular pattern. The one we're most focused on is crude oil.
Oh, all right. Pull that up.
And yeah, I like that drop, and you showed natural gas. It took out a prior low. I like that because that means it cleaned itself out.
Oh yeah, right,
Lows,
right
yeah.
here to
And
there.
look what happened. If you sold that breakout, you got killed.
Yeah,
Okay.
yeah.
Price chart can often be illusory. Okay. Anyway, go to crude.
Crude, WTI. Okay.
Now, okay, there's your 2022 high, I think. No, that's 2023. Excuse me.
This is
Yeah, now you
2023.
got,
Oh, there
yeah,
we
there
go.
you go. Okay.
Okay. So this is
Fully,
COVID down here.
yeah, okay. That's fully in sync with the Bloomberg. You made a low in late summer 2020. You exploded to early 2022,
Hmm.
same as Bloomberg. Peaked at the time of the war. So the talk that, oh, Russia caused the oil shortage. Crude had already gone off the page before the war even commenced. And when the war started, crude started down. Okay, now look at the range lows you've seen with that white line. You got it at 67. You can drop it down a couple bucks to about 65, really.
Okay.
Yeah. Now, in the panic in the stock market early last month, they figured, well, since Trump says drill, 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 and we're going into recession, I guess that means less demand for oil, right? Okay.
Yeah.
Or more oil, whatever. Either way. And let's drop it. Okay. So they plunged it down into the 55 level in
Yeah.
that first break. And then they shot back up and look where they failed.
Right there at the same line.
Right up under the 65 level.
Yeah.
2 weeks in a row, they traded to 64.80, 64.90. Okay. The guys with their crayons drew their line. Okay, fine. You drop back down, tested the low recently. Now you're up to about 59 again, I think.
Yeah,
And
58, 59.
yeah, okay, yeah. If you ever get back above the 65, and our view is probably this is a bear trap. It's what you just saw.
Oh.
If you get back above 65 again, price is even telling you, that was a trick. I fooled you, okay? In other words, I'm going back above the normal low range of the prior couple years. So I'm back in safe territory. We have a momentum breakout of massive proportions if you ever get up to around 72 during this quarter. Yeah, right there. Now, if you draw a trend line, it comes through at about 76 or 77 going back to late 23. If you draw that trend line, yeah.
So right there. Okay,
yeah. But price momentum says, yeah. Well, we even go back to that prior high on momentum. We've got it. Yeah, that's not a valid trend line because it's only like 2 points there. But we've got like a 4-point downtrend going back to the peak in 2022. And it says you get up to 72 this quarter, probably next quarter about 69. You're going to blow that structure out, meaning momentum says, I'm back in bull mode.
Yeah.
And I preceded the upturn with a flush out. Remember the flush out in gold? They got the 1600.
Yeah, 1650.
Yeah, okay, yeah. It's a bear trap. I think this is a bear trap. Now, the first evidence of that, get back over 65.
Okay.
And then you do that, and I'm gonna bet you the Bloomberg's pushing up toward 105 at that point, 106 something above there is an annual momentum breakout for it. But crude oil has not been a participant in the steady Bloomberg chart. It was, yawning. Crude had this puke out. So the question is crude smarter than the broad commodity complex? And commodities are going to collapse like crude, or is the crude break a trap? My bet right now is a trap. Evidence of that's getting above 65. Okay. And if it's a bear trap, crude could explode up out of here because it's got momentum structures that say you get back up into near that 70 even. Watch out. And that would shock a lot of people, including President Trump, I'm sure.
Yeah. I was just talking with Rick Rule about this yesterday. And so, he's not a chart guy like we are, but he basically said that $60 oil is unsustainable. And he said that, short term, and for him, short term is a couple of years, it could get down here. And basically what you're going to have is you're going to have Exxon and Chevron just gobbling up all these little companies that can't make any money. Yeah. And the more violent it goes down, the more violent it's going to go back up. And, but yeah, that his kind of kill switch was $60. At that point, the world is basically breaking even on oil. And what's the point of drilling something if you're doing it all to break even?
Plus, just because the president says drill, drill, drill doesn't mean you can do it right away. It's not something you do tomorrow. Oh, it's in the ground and pumping, But I love that line you got at 65 there. Look how broad that is.
Yeah.
I didn't realize it went
that
far.
I got to go out to the weekly here to put
that's lovely.
Perspective.
But anyway, you get back above that level and it says, hey, that breakout you think you see there?
Yeah. Yeah. Okay. Awesome. And let's see. So that hit the hydrocarbons. This one's interesting. So T Quinn is asking about momentum in national and regional retail housing and rental markets. Do you follow anything
Well,
with
we follow the commercial real estate market, which includes some companies that deal in that. Okay.
Mhm.
RWR is an ETF in that, and VNQ. Okay.
Okay,
Uh, yeah, you
RWR.
punch up RWR, for example. Go to a monthly if you can.
Okay, here we are. Oh, I got to share screen. I can see it all you want,
Again,
but
this
if I
is
don't
this
share
is not
screen,
mortgage real estate so much as it's commercial shopping centers, industrial complexes, et
there we
cetera,
go.
computer centers, et cetera. Uh, yeah, now see, we see a peak back in 2006 at about 100, okay?
Right
Then
there.
you see peaks in 2016, 17. You can go sideways at 100 for the past 20 years,
Yeah,
okay?
yeah,
And right now we're at 90 something, okay? But look at that 2022 high up there at over 120. Okay,
yeah.
now that's when the S&P was 4,800.
Huh.
Okay. And
Okay.
then we had to pull back into 2022, okay, on RWR2. And when the market turned up, it turned up too. But look where it ran up to. The old high in 2018.
Oh, yeah,
Yeah, it's like a
right on
shoulder
there.
there almost. Yeah. But the point is that it didn't go to it didn't return to its highs and
Yeah.
exceed its highs like the broader market did. Okay, now that means, yeah, I'm playing the game with the market. I'll go with it, but I'm not going as strong. Okay, so it's definitely a weak sector terms of long-term returns. Okay. Now, we have structures below on quarterly momentum that have already been broken. That price chart, if you try to draw a line, you can maybe find 2 points, and maybe the recent low looks like a third point or something. But this guy's already broken. Yeah, there you go. That probably is a valid trend line now because you bounced off of it. But momentum's already broken that comparable line.
Yeah.
But price bounced off of it. And now, if you go back through that low, bet on all hell breaking loose.
Oh, okay.
We know now, I don't pay attention to this stuff because, again, it's fundamental. But I hear repeatedly from analysts that that sector is loaded with long-term debt, and a lot of it's coming due this year and next,
Okay.
long-dated debt. And I heard about a month ago that the biggest shopping center in the U.S. defaulted on $300 million loan.
Oh,
300 million. Yeah. Okay. Well, there's one little story and it came up and it went away. But the way this sector is behaving, I think you need to watch it. Now,
okay.
momentum says you're not going to hold. Price says, oh, I bounced off an idiot 2 point line. Okay. Now it's a valid 3 point line. 2 point lines aren't valid. Three, they get more valid,
Yeah.
even on price. Don't want to go back to that last low. You do. You're going to start to hear headline stories. Well, obviously, the impact of any failures in this sector will hit what? Financial institutions. Okay, so then watch the banking sector. Because if that guy goes, you start to hear a story there. That's what the public panics about. Shopping center going under. Okay, fine. $300 million. Well, that's a lot, but I didn't even hear about it hardly. Because it wasn't really well publicized. But if you start impacting the lenders of that debt,
Yeah.
that's
Yeah.
when it gets headlines.
Yeah.
So we like to look inside the market at sectors that are critical that people aren't focused so much on.
Okay. So
This
you're
is one of
saying
them.
if this
Yeah,
idiot line right
let's
here
say
gets
that
drawn, that's
momentum
where you.
says it's going to happen. Momentum already says it's going to happen.
Okay.
But price says, okay, I found the last stopping point.
Yeah.
Okay. So
Yeah.
as it happens, it's a nice little line.
Okay.
Admittedly, each time you hit it was a brief spike. It didn't even sustain down there. It was a hot low. But that's now a 3 point line and it's valid. So that's down around 85. You don't want to go back there again. And the same is
Okay.
true of the broad market. You do not want to revisit the April lows. There's some
Yeah.
momentum reasons for that.
Okay. All righty. And Winston is asking, he says, he has previously mentioned the Fed may not survive the blowback from the upcoming crash. Can you elaborate?
I think a lot of things, because of the nature of the pending market and economic crisis, not only government debt, but we talked about commercial real estate, the biggest stock market bubble in history. When these things fracture, reality takes over, and no central bank can stop it. They've tried before, and it never has worked. It just creates the next bubble. But in this case, the bubble is so big that the wave effects could be far beyond what we think of normally. Like 2007 to 9, suddenly, and August of the September of 2008, Lehman went under. Ooh, shocked everybody. The Fed finally came in 2 months later with QEs to try to put out the fire, and that didn't even work. But this is so big that the wave effects could be almost in the street, so to speak, and maybe literally. But also it creates doubt. People say, oh, these ideas have prevailed for decades. These institutions have prevailed for decades. We've had central banks for now one very long human lifetime. That's all, about 107 years of the Fed. It hasn't worked. Throw it away. So when you get hurt badly personally by markets, suddenly your retirement account dropped 30% and you were hoping on it, and that was the only thing made you smile last year. Okay. And now suddenly that's gone and you don't own enough gold. So suddenly you get emotional. And when people get emotional, they reflect that politically, sometimes in the streets. They reflect it by rejecting ideas, institutions. And it would not shock me that there's no central bank, no Federal Reserve, next several years. Wouldn't shock me.
I hope you're right. I really
Well, I think, it's not, it's got justification too.
It does. Yeah. It's I can't remember who told me, but when they said something to the effect of like, every time you hear the word inflation, think to yourself, replace the word inflation with central bank theft, because that's actually what is happening. They are slowly stealing from you. And when you get these spikes in inflation like that, the public kind of wakes up to it like, hey, something's off. They can steal from you at 2% a year, and it's like no one notices. But when you have moments like we did in 2020, and they steal a lot more quickly, it's kind of like the jig is up. So
the inflation shouldn't be defined as what are egg prices or CPI. So it should be defined, well, what's the increase in the money supply? That's inflation, okay?
Yep.
And it has wave effects. Sometimes it helps the stock market, and when it's not working there, it definitely helps gold. Every time, big time.
Yes.
Go back 100 years, it's the case. So this time, given the nature of the breakage, the nature of the response could be even more ludicrous than before. More off the page in terms of panic by central banks. Like the head of the Boston Fed said, we have multiple tools, okay? They're loading up, okay?
Yeah.
I know they don't want to cut rates today because that would mean they're giving in to Trump, okay? They look like, little cowards. So, but by delaying, maybe they make it work. Anyway, it's a fun game to watch, and they're not in control. They're not in control.
Yeah. Yes. Well, thank you very much, Michael. A lot of thank yous and everything in the comments. Really appreciate your time. If viewers want to get a hold of you and follow your work, how can they do so?
OliverMSA.com.
OliverMSA.com.
Yeah.
We'll put a link down in the
Thank
show
you.
notes. I get your newsletter. I like it a lot. And
Thanks, Steve.
Thank you.
Okay.
And thank you for tuning in. Go to stevebartonmoney.com for more and have a wonderful day.